Hello, hello, and welcome to this week's Profit Maximizer Moment. This show is dedicated to helping business owners dramatically improve their bottom line with our weekly profit maximizing tips that you can use now. I'm your host and coach, Wayne Belisle. I'm also the founder of a local CPA firm that works with business owners, help them make more money, keep more of it from the IRS, and simplify their life. I do this with our profit coaching programs and our tax planning systems, which has saved my clients over 6.8 million. We're already over 7 million. We're in the middle of tax planning time right now. Over the last 5 years, again, all legally, I love my clients, but don't really wish to share a jail cell with them. Thank you very much. In today's video, we're going to talk about 36 tax tips to save business owners thousands of dollars every year. Probably not going to get into it in that level of detail. May go through them pretty fast because I just had a tax planning meeting today. Went from like 2.5 hours. Okay. So, it takes some time. So we're not going to get fully in detail in that. And I'm going to tell you right off the bat right now, it's important to let me put my phone on do not disturb. Let's do that. I meant to do that before we started. Darned if I don't, the phone will ring. There you go. Can't guarantee what it's going to save, but we're pretty sure it's going to save you something. So it's just a question of time. Hey, this week's tax, but first, support for today's show comes from Profit Maximizing. Boy, my ring light is really making that bounce off the cover, isn't it? Oh, well. The 90-day profit reset. I'll try to move it around so you can see it. All right, let's go there. Got to learn, got new things, so we got to learn. 90-day profit reset, which was brought to you by Profit Maximizer Publisher. Shows you how to gain your independence from reduced cash flow, shrinking margins, and evaporating customer base. In this book, you'll find chapter after chapter, idea after idea about how you can turn around your business, reset your profits from red to black in 90 days or fewer. Even entrepreneurs who are making money will benefit from this book, guaranteed. This book is designed for you to sit down once a year, kind of make sure you're dotting your I's, crossing your T's, and there's not something you can find. Should you read it every year? Yeah. I've gone to courses I went to a few courses 2 or 3 times. And basically, even though pretty much the same material, I was in a different spot. I was ready for something that I wasn't ready the year before or 2 years before that. All right. I'm going to go skip pretty fast and let's talk about year-end tax planning tips for small business owners. Look, I watched last week's video. It explains why we do tax planning. I'm not going to get into it again, but I can't even tell you what it's going to be. In this article, I got one where I remember meeting with a group of partners that were set up in the wrong entity. They were set up as a partnership, which was costing them, about $45,000 a year. Imagine if they were in business for 10 years, that would be $450,000. In 20 years, $900,000. And that's money they would have paid the IRS just because they had the wrong business entity. I'm sure they were able to find, I know they were able to find something better to do with it than that. Okay. More than that, there's a lot of things you can do before year end. There's a lot of things that we go, make sure you watch last year as we get into it. First thing that I stress is make sure you know the rules of income tax liability, what's taxable, what's non-taxable, and see how you can take advantage of the items that are non-taxable. Makes sense. General rule, though, is if you can't find a place that says it's not taxable, it's taxable. And the opposite of that rule is if you can't find a place that says it's deductible, then it isn't deductible. All right. So first thing, shift income. Second part, shift income to later years. This is most often accomplished with a tax-deferred retirement plan or annuity by collecting receivables in January instead of December. If you're on a cash basis, delay billing. Gets a little trickier if you're on a percentage of completion for construction. Get with your accountant. By the way, all of these items, yeah, you can do a lot of this yourself, but everybody's situation is different. And sometimes it doesn't make sense to do some of these that way. So sometimes you're better off delaying, never know. All right, I had an example today where they traded in a truck. They were planning on trading in a truck to get an SUV. Problem, the exchange, where you could make it non-taxable, 1031 exchange and equipment disappeared in 2018. All right. So they would have picked up $50,000 in income because that was the trading value they were going to get. And since it was an SUV, the most I could write off was 25. So that trade-in would have created $25,000 in income. If they didn't meet with me, they would have made that mistake, and we would have ended up, when we did the tax returns, too late. We're looking at history. So see if you can shift income into later years. Opposite of that is accelerate deductions into this year. All right. Review your income statement to see what can be paid before December 31st. If you're looking at buying equipment, you might want to buy it now. Prepay expenses using the IRS safe harbor. IRS regulations contain a safe harbor rule that allows cash basis taxpayers to prepay and deduct qualifying expenses up to 12 months in advance without challenge, adjustment, or change by the IRS. So even if you're not a cash basis, you can sometimes prepay some things. Again, I in this video, I'm not going to get into the details of that, but consider prepaying rent. Maybe if you write it in January 2nd, do it on December 31st. Property taxes, instead of paying them in January, pay them in December. Again, it's best to get with somebody who's doing that right now and do full tax planning plan so that you can figure out what you're doing. You can use a credit card if you don't have the cash, you can charge it to a credit card, which will allow you to take the deduction in the year of the charge and then pay it later. All right. If you expect income to be higher next year, you just reverse 2 and 3, accelerate income and postpone deductions. At the moment, they haven't passed the plan. Not sure what they're going to do. We'll have to look and see. I'm not convinced that they're even going to pass anything, but if they do, then we'll talk to you about it. Now, another thing you can do is shift income to taxpayers in a lower bracket than yourself. This can be between you and other family members, or by establishing a management C corporation, a management company. Again, trickier. Make sure you get with the tax preparer. I'm going to say this over and over again, so I'm going to say it once and forget about saying it again. But every time I bring one of these up, you really ought to get with your tax preparer and make sure that you're doing it correctly. But I tell you can't, and I'm telling you can. You need to find somebody who knows the law better or is a little bit more aggressive. I'm not saying, like I say, I'm not going to take anything on deductible. I'm not going to cheat, but we can do things. All right. Number 8, turn after tax expenditures into tax deductible items. I had a boss once that said every taxpayer should own a peanut stand or a popcorn stand. What he meant was that everybody should have a side business, even if they're a wage earner, which allows you to deduct things you normally wouldn't be able to, that you would normally buy anyways, and do it after tax basis. For example, probably want a laptop. All right. But if you got a business, you definitely have a good reason to have a laptop. All right. And you can deduct most of it, if not all of it. Take advantage of as many adjustments to income deductions and tax credits as possible. There's no real magic trick here. You just have to know what's available. So get with your tax preparer. Make sure you know what they are. Make sure you take advantage of it. Number 10, I kind of touched on a little bit. Choose the right business entity for your particular business. As a general rule, real estate should not be held in a C corporation. As a matter of fact, normally you don't want to put real estate in a C corp. An LLC, fine, but make sure it's in an LLC that does not elect to be a corporation, and it can just be an ignored entity or a partnership. On either way, it doesn't matter. Because what you don't want, I've seen this before, this is a big mistake. Having real estate in a C corp is a regular corporation. It pays its own tax, but when it sells a piece of property, it pays the tax on the sale. Then the money comes to the owner, and the owner has to pay tax again, as if it was as a dividend or however they take it out. Almost all real estate is held in an LLC and taxed as a partnership or as a disregarded entity. And normally between 85 and 90% of small businesses are set up as an S corp for 2 reasons. It eliminates the discussed above, as I just discussed, and it limits Social Security and Medicare tax payments to the amount of the owner's salary rather than the total profits of the company. But be careful. The owner must receive a fair and reasonable salary. Again, this is based on the facts and circumstances, which means everybody's a little bit different. So, again, get with somebody that can tell you what a fair salary would be. Make sure you're not giving yourself a salary that creates a loss. I've seen that. So now I'm paying, I made $20,000 in a business, pay myself $50,000. So I have a $30,000 loss. Yes, for income tax purposes, they just offset each other, but I just paid Social Security on the whole $50,000 instead of $20,000. So make sure you're doing this right. Set up a medical reimbursement plan. Healthcare costs can only be taken as an itemized deduction out of pocket if the out of pocket amount exceeds more than 10% of your income. Basically, unless you just have a really sick item, you're not likely to get hit with this, okay? But a medical reimbursement plan, if set up correctly and under the right circumstances can really help because now the business is able to deduct it. If that's too expensive because you have too many employees, consider an HSA, a health savings account. If you have a high deductible plan, which most of them are nowadays, then you can put up to $7,200 a year for a family. Half of that for single. Now, it works like an IRA. If you don't use it, you don't use it, but it carries forward until you might need it in the future, and it's fully deductible in the year I do it. Usually, like Blue Cross Blue Shield, I think if I remember right, they give you a debit card. You go pay your deductible. You just use that, and basically, if you have it when you retire, I would say save it because medical bills get higher as you get older. But if nothing else, you can use it as retirement too. All right. Take advantage of the home office deduction. This deduction is probably the most misunderstood deduction in the entire tax code. For years, it was an IRS red flag. Now it's much less likely to be an issue because there are certain steps you have to go through. It must be either your principal place of business or a place to meet with customers in the normal cost of business. You may also deduct a home office if the space is a separate structure detached from your residence but used in connection with your business. Consider renting your main home or vacation home to your business for fewer than 15 days. Your business can deduct the rental and you will not have to report the income. It's often called the Augusta Rule. Basically, there was a congressman. The story I've heard is there was a congressman that lived in Augusta, Georgia, where the Masters is held every year, and there all the people that have big houses, they rent them out and get the heck out of Dodge while the crowd's there. And this guy didn't want to pay taxes on the rental, so he passed it. And we, as a business owner who or doctors that do their monthly billing or do their monthly work at home, rent it at fair market value to their corporation, take a deduction there, and don't have to pick it up as income. Now, do it right. Go to LegalZoom or get an attorney or somebody to do an actual lease agreement between you personally and your home and the business. Okay. Document all deductible meals. If you were ever audited and have no documentation, the IRS agent will disallow the deduction. Look, one tricky thing that came up recently is that it used to be I could only deduct 50% of my meals and entertainment. Now I can take 100% for the years 21 and 22 only. Well, I already talked about this a little bit. Pay property taxes in December, not January. Pay your January rent or building payments in December. Look into creating a retirement plan. Way too many options here. You can do a simple, you can do a SEP, you can do simple IRAs, 401k, defined contribution plans, defined benefit plans. There's a lot there. All right. There's way beyond the scope of this, but look into it. Year-end hiring equals savings. Take advantage of small employer health insurance credit. If you provide health insurance, make sure you don't forget this. All right. If you don't, you might want to just give them the cash and you can take a deduction. If you're going to buy equipment, make sure you do it before the end of the year. Normal equipment, larger pickup trucks, panel vans that you use for delivery can be deducted 100% in the first year. That's phasing away that special, but you can still use it. And then you got Section 179. So that bonus depreciation is available through 2022, then slowly eliminates itself all the way up to 2026. But unless you're doing more than $2 million in assets, you probably can deduct most of it. For years beginning after December 31st, 2017, expensing that first year expensing is also available for qualified improvement properties. This is normally improvements to the interior of a business property. It usually includes also roof improvements, HVAC, fire protection, alarm systems, security systems for rental properties mainly. So if you're renting a property, but also if you own, okay. Bonus depreciation, I talked about that. Heavy pickup trucks or SUV for work can result in a big tax write-off. Be sure to check again with your tax preparer because the rules are tricky. And normally a big pickup that's over 6,000 curb weight, which is getting harder to do. An F-150 is usually right below it. F-250 you probably can. Some of the other stuff I can take 100% in the first year. SUV I can usually take no more than 25,000. A vehicle, a business car, I can take 10,100 in the first year, 16,100 in the second year. All right. Consider when you're calculating your auto expenses, like gas, fuel, repairs, maintenance. I can do it either under the cost method or under the mileage method. Consider doing it under both and see which one's better for you. If you drive, general rule, if you drive more than 12 to 14,000 miles you're better off with mileage. Okay. But either way, make sure you track your mileage. There's simple things. I use Mile IQ on my phone, so be sure if you do it. If you have losses in your partnership or an S Corp, be sure that you have basis to deduct it. In English, that means you had enough investment to cover the losses, or you're personally liable for the loan. That also counts. Again, if you're going to have losses in an S Corp in particular, make sure your tax writer knows about it. Tax preparer helps you with that. All right. Go through your receivables. Can't tell you how many times things are on receivables. They're picked up as income. If you're on an accrual basis, make sure you write off any bad debts. Look at inventory. I've seen receivables. I've seen over $200,000 that somebody paid taxes on, but they never collected, so we had to write them off. Inventory just keeps growing. Make sure you take a physical inventory, get rid of the old inventory, write that off too. If you got some inventory that isn't selling that fast, or is about to go obsolete, consider donating it. You can write off 1/2 of the difference between fair market value and your cost, which is your original cost less depreciation if you're getting rid of equipment. So that's where we're going. So, you might want to go to eBay, see what something's worth, and that's what can be your deduction. Don't forget the new 20%. It's not that new now, it's 2018, but to 20% business deduction, which means only 80% of your qualified business income will be taxed. That's great if you're not a C Corp. This is for Schedule Cs, sole proprietors, partnerships, and S Corps. All right, a large break. If you own a profitable business, you definitely need to contact your tax advisor to ensure you don't miss out on this. Make sure they do it right. I've seen returns that were done wrong. If your income is too high for the 20% business deduction, you may want to look at ways to reduce your income so that you can qualify. There's phase out. So a lot of times that's where tax planning comes in. I had one where they weren't going to qualify for it. We did a little bit of tax planning, bought some equipment, prepaid some stuff, delayed billings, things like that. Got it to where they qualified. All right. There's also a tax credit for wages paid to employees on family or medical leave. Make sure you take advantage of that. Also review employee retention credits. I discussed those, but year-end's a good time to see whether you qualify. You can find the video I did on that. If not, contact me and I'll help you with that. Switch from a cash basis of account, switch to or from a cash basis of accounting. Very tricky. There's rules on how to do this correctly, and it may not be the right thing for you, so you need to really look at it. But it used to be that, if your receipts were over 5 million, you had to do an accrual. That now went up to 25 million. So sometimes it doesn't make sense to be that. Deduct your smartphone. Deduct your smartphone and provide smartphones to your employees. They're considered a tax-free fringe. Design a business trip that includes some personal days that you can treat as 100% business, even if you don't work on those days. Okay. For 2018, there's rules on that. Don't go crazy. Make sure you look up the rules, talk to somebody that tells you what they are. For 2018 to 2025, itemized deductions for employees with unreimbursed expenses were eliminated. Consider reimbursing your employees, including you and your family, if they're employees under what's called an accountable expense reimbursement plan. Be sure, again, to see your tax preparer. These are tricky. What I'm trying to get across, I went through that way fast. That was 17, 18 minutes, which was 16 minutes, probably 15, 16 minutes longer than you wanted to hear. All right. But what I was trying to get across as much as anything is there's tons of things that we can do to help you cut your taxes quickly. All right. Next week won't be as long because we're going to be talking about tax deduction for real estate. The week after year-end tax tips for real estate. The week after year-end tax tips for the rest of us, individual filers. My brain went away for a second. Look, you can decide now to cut your taxes. I did one today. It wasn't that much. I only saved them $29,000. That's on the low side for us. Can you not think of something to do with 29,000? Honestly, we charge $2,800, so I got a 10-to-1 return. What else are you going to get a 10-to-1 return on? I'm serious. So take this seriously. I'm doing this on purpose. I know it's long. I know it's kind of complicated. I went through it fast. I could literally do an 18 to 20-minute video on almost any one of these single items. All right. So, hey, until next time, thanks so much for listening. I'll see you next week with another profit maximizing tip. And let's keep working to make this coming year the most profitable one ever. And then, like I said, we're doing 3 things: helping you make more, keep more from the IRS. And that's what these 4 weeks are about. Talk to you later. Thank you very much.